After watching the markets move on Monday, I couldn't help but think of Kevin Bacon standing in that enormous crowd yelling, "Everyone stay calm. Everyone stay calm," as chaos overtakes the crowd. Some people were surprised. I didn't know this could happen. What do you mean? Volatility index could go from 15 to 60 in a few days. What are we teaching our young financial experts and young investors and even the older ones? Can't stock markets go down? Why aren't they allowed to go down? I also on Monday got to experience watching the cattle market open halfway to limit down and then trade limit down immediately. We didn't see the USDA making an emergency announcement paying farmers and ranchers. Why should the Fed immediately lower interest rates? Because we traded down 5% in equities? Our next guest talks facts, not feelings. Welcome to the show, Rebecca Walser.
Hi, Tommy. Thanks for having me.
Absolutely. So I don't know where you were on Monday. I know you've been traveling a lot, doing a lot of things. But when you woke up, what'd you think when you woke up Monday morning?
Well, the first thing, of course, I checked was the Asian markets, and I knew immediately when I saw the Japanese market that, there's consternation back and forth. Some people say it went down 13.47%. Some people say 12, over 12. The bottom line is over 2 days, it actually went down more than it did in 1987. And we know that Japan has been really, Tommy, in this long-term stagflation, decades of periods. They've had negative interest rates. They just raised in March. And then, of course, really what triggered this whole situation, there's a lot of data out there that had an impact. But what triggered this, in my opinion, is their raise, the Bank of Japan raise on July 31st from, to 0.25. And that really made a lot of the carry trade unwind, which is, a liquidity driven event. And I don't know if, listeners and viewers understand it. It's very complicated. So it is a hard topic for a lot of Americans to really understand what's going on.
Yeah. And we're going to do a two-part segment. You and I will be on this first segment on the A block. Then we got Bob Ichino. So we have time. We don't have to cut it all in one little segment here, but I'll tell you, it's complicated. Now, yes. Why do people, younger people, think that markets can't go down? Why did my cattlemen and cattlewomen, ranchers, have to watch feeder cattle go limit down? I didn't even hear, they weren't happy, but they didn't complain. Why do people think stocks can only go up? Who gave them this idea?
Well, I would say the Federal Reserve and modern monetary theory and the combination of the two, which we clearly under, I don't want to say necessarily under the Obama administration, because I really see the GFC as the jumping off point that changed everything. But definitely Bush started the TARP, the Troubled Asset Relief Program, from the global financial crisis or the great financial crisis, the GFC in 2008, 7, 8, 9. But then Obama came in, and that's when the modern, although it's a Federal Reserve situation, things were changed, things were shifted, and modern monetary theory, for the listeners, to understand, it's basically this economic theory that there is unlimited government printing as an option. Like, we don't have to ever collect or pay off our debt. In fact, debt is never paid off. It is just refinanced with new debt. And as long as you can constantly collect enough revenue sources to pay the interest to service the debt, as long as your economy is functioning to generate the interest payments, then you don't have to worry about ever actually cutting into the capital. This is a crazy theory. A lot of people believe that, it's the savior, it's going to save us. And the fact is, we are still waiting for that to unwind from 2008. Really, I mean, because we've not been allowed to have a correction. To your point, in 2020, when we voluntarily shut down the world, we printed globally the equivalent of 20 trillion US dollars globally, not all in the United States. Other countries obviously had their own stimulus programs. But you can't go through a global pandemic and say we're going to shut down the world for the first time and ever, because we didn't do that with smallpox in 1917. We didn't do that back with global pandemics. This was an experiment. It shut down the economy. All the central banks printed. We printed immensely here. And that's why, Janet Yellen first said, inflation is transitory. And the whole idea and concept of a soft landing is the fact that we can go through a coronavirus and we can hyperstimulate our in currency, and there's no repercussions. We will just have a nice, continuous and constant growth trajectory. And I think that it's really sad, Tommy, because when you look at the S&P 500 chart and you look at 2008 to present day, it's just basically following 100% monetary policy and stimulus. Yeah. So in other words, if you extracted all of the monetary stimulus, these studies and the analysis are that we really only have between a 1% and 3% actual return on our companies in our markets. So the hyperinflation growth that we are used to of 10 to 20% a year, .com started at, and kind of now we're in the AI space of that, that is not really what's happening in the absence of basically almost next to nothing cost of capital. So if you don't have a cheap cost of capital, you aren't going to have the growth that we've had in the last since 2008.
Yeah, 2 points. As you were speaking, you said we printed about 21 trillion with the T, correct?
Right. Globally, 20 trillion globally. Yeah.
When we went into the, we'll call it the debacle of 2020, I hate to even use the terms or don't know the correct ones to use. The global economy had at that point 12 to 14 trillion in negative interest rates. So people out there, farmers, ranchers, the viewers of this show, they need to know we went from a world market that had $14 trillion of negative debt, and then they printed that 21T. And that's what caused the inflation. When we say there's no effect, the effect was rampant inflation, the tax on the poor. Real quick, we have about a minute left. One of the good guys, bad guys, the Bernanke put cost me a lot of money. I didn't understand that the government would have that Bernanke put. I was bearish the market, and he would just come in there. They'd go to the big boys in Wall Street and girls and say, you know what? We got you covered. We got the Bernanke put. 30 seconds. What do you remember from that?
Oh gosh, that's going back in a ways. But you know, I just want the audience to understand that everything really changed in 2000 with the 2008 global financial crisis, GFC, Great Financial Crisis. I call it the global financial crisis, and that's it. Like once that was a jumping off point. We have not, to your point is so important that we have not been allowed to crash. Even 2020, we literally grew in 2020. 2022 is the worst year we've had, and that was because they finally started dealing with the fact that inflation wasn't transitory. So as we started to raise rates in the middle of that year. So I'm just wanting people to understand this is far from over. The volatility has just begun, especially 90 days to the election. We are in the thick of it now, and be prepared for volatility because this is just the beginning.
Well done, Rebecca Walser. You know what they're saying in my ear? They're saying two things. You're awesome, and Tommy G. Rap. We'll see you next week. Thank